To the joy of crypto bros around the world, the SEC last week finally and begrudgingly approved the issue of Bitcoin spot exchange-traded funds. Now, these are listed funds that will trade on the NYSE, the NASDAQ, or CBOE, and they'll hold sort of physical Bitcoin that's purchased via crypto exchanges and held with custodians such as Coinbase. Now, this is different to holding Bitcoin directly. Investors won't need crypto wallets or accounts with crypto exchanges of their own, and the funds will be run by SEC-regulated fund managers who have stringent governance, compliance, and risk management rules to adhere to, unlike most of the crypto exchanges out there today. In the last couple of years, Bitcoin exchanges have had a pretty rough time, with companies like FTX and Binance either collapsing or being involved in large-scale fraud and money laundering. So aside from making crypto more accessible for everyday investors and probably making it more attractive for institutional investors, these ETF structures are expected to bring a sort of high degree of trust and legitimacy to Bitcoin. That's the theory anyway. Now, the SEC certainly doesn't seem thrilled about this. They have effectively been forced to approve these issues as the result of losing a lawsuit brought against them by Grayscale, who's one of the issuers of these ETFs and been trying to list a fund for some years now. SEC Chairman Gary Gensler made no real attempt to hide his skepticism. Here's some of his comments. Bitcoin is primarily a speculative, volatile asset that's also used for illicit activity, including ransomware, money laundering, sanction invasion, and terrorist financing. While we approved the listing and trading of certain spot Bitcoin ETF shares today, we did not approve or endorse Bitcoin. Investors should remain cautious about the myriad risks associated with Bitcoin and products whose value is tied to crypto. He was no doubt particularly unhappy that day as the SEC's Twitter account was hacked the day prior with a false announcement that approval had been issued. Now, I used to work in the technology sector in a previous career, and I know just how bad it can be to be the subject of an attack like that, but it's still pretty funny. Now, the statement was quickly retracted, but it did cause some sharp short-term volatility in Bitcoin, and it really just sort of provided another reminder of just how much of a wild west this crypto stuff really still can be. So far, 11 funds have started trading, and they generated 4.6 billion of trades in the first day of trading alone. Fund managers who have launched products include BlackRock, Fidelity, ARK, Grayscale, and Invesco. There's some heavy-hitting names there. They're no doubt excited to be at the forefront of a new sort of asset class, the first really new asset class to hit retail financial markets in a long time. And they're also no doubt very excited about all the new fee revenue that these funds will generate. Okay, so what's my take as a financial advisor? All right, well, I need to preface this by saying that everything I'm talking about here is general information only, okay? So I'm not covering anything in this video that could or should be considered personal financial advice. I'm licensed to provide financial advice in New Zealand, but regardless of where you're watching this, you should always seek professional financial advice in your jurisdiction before making any investment decision. And that includes tax advice as well. So with that out of the way, here's some general thoughts for Kiwis watching this. Now, first off, the only way you can buy these ETFs right now is through offshore brokers, and none of these funds are registered in New Zealand. Now, that means you're not going to be afforded the protections that exist under the FMCA that come with funds offered here at retail. And if anything goes wrong, your recourse is probably going to be quite limited, or you'll find yourself needing to sue in a US court. Secondly, I do consider Bitcoin and crypto in general to sit right up the top end of the risk spectrum, and it's a highly speculative asset class. Bitcoin generates no cash flow, it's highly volatile, and there's sort of some merit to the idea that it could serve as an inflation hedge or a hedge against volatility. But there's really little evidence so far that it's that effective in that role. Bitcoin does appear to be highly correlated to equities as well, which makes it pretty useless in reducing portfolio volatility like you might use bonds to do. Third, just touching back on the SEC's comments from earlier, crypto is often associated with criminal activity. So if you're an ESG investor and that's important or relevant to you, you might want to sit this one out for now. It's also been the running target of scams, hacks, security breaches, etc. over there. Now, I will say, though, that the arrival of professional regulated fund managers might at least improve custodial practices, including security and governance practices. So overall, if you're interested in taking a punt on Bitcoin via these new ETFs, just be well aware of the risks involved. Don't invest any money you can't afford to lose. And I do strongly suggest seeking professional financial and tax advice before you make any decisions. For investors who do want some exposure to Bitcoin, at least for now, they have an easier and potentially safer way to do it.